All right. Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for May 12th, 2025. We are recording this at 7 p.m. Eastern Time, and this is episode number 476. So also, before we get started, just a reminder, we have a huge event this week. The title is 30 Pillars of a Profitable Trading Plan. So from uh, tomorrow through Thursday, we have 10 presentations scheduled each day, 30 different educators who are going to share elements of their trading plan and process and how they make money in the markets. So be sure to join us on TimingResearch.com. If you just go to the site, Timing Research, you'll be able to you'll see a link to join the room each of the 3 days. So that'll be tomorrow, Wednesday, and Thursday, 10 a.m. Eastern Time until 8 p.m. Eastern Time. So be sure to join us for that. And so now I'm going to turn it over to the option professor.
Okay, thanks a lot, David, and thanks everybody for being here. It's a exciting day in the market because we were kind of blindsided with news here. I don't think anybody going into the weekend thought that China was going to come out with the same tariff rate as England, but that's what they did. They came out with a 10% tariff rate, and that's the same as the UK got. So I guess you'd have to say China went from the least favored nation to the most favored nation. So we got lots to talk about because there's been a lot of volatility. Quick introduction. I'm Jim, the option professor, graduate of Boston College. And I've been doing options pretty much for decades, educating people on options, trading options, and basically being involved in options, trading thousands and thousands of contracts. So I think I'm qualified to give you some information on the option area. That's what I'm going to do today. At the end of the broadcast, I'll go over my options alert service so you can get an idea how that might benefit from you. And if you have anything you'd like to chat about, I guess we have a chat box up there. So if you have a stock you'd like me to look at or something like that, if you put it up there, I'll try to get to it. Okay. Let's just get started here on what happened here. I'm looking at the S&P 500. This is the cash index, SPX. And as you can see, I'm going to start with the 20-year graph because I'll show you. This is what I put in a market review every week. And so this is what I've been talking like in the reports that people get when they're subscribers. The S&P had a big reversion. And there was a reason why I thought it might go down to the 4,800 area. And there it is. I work with moving averages because I think they're very good to work with. And some of them tell me what the trend is. Some of them tell me how far the trend might go. And the other one gives me reversion to the mean levels. So the ones that I work with, I find very effective, not only because there's some magic numbers, but I feel like I know how to interpret them. And that's obviously a big thing. So when Rome is burning, I'm telling people that we're going to go down to the former highs of 2022, and that's around 4,800. And then the blue line came in here at 4,800. And the only way you're going to go down to the purple is if we have a full-on recession. And one thing Donald J. Trump has no interest in when he's trying to get a budget passed that's full of red ink and a debt ceiling up to 6 trillion, almost 5 trillion more or whatever. He's not going to want to be unpopular when he does that. So the likelihood he's going to call off the tariffs that got us down here is a very, very high amount. So although I didn't think it would go down to 10% in one day from 145 to 10, that sounds like the lawn chair being folded as we speak, right? But that's what happened. And again, there obviously was a deal said that, hey, let's give these guys 10%. Let's get this off the front page and let's start talking about that budget deficit. And let's start talking about the debt ceiling and maybe throw in the rule books on regulation out the window so we can get some more business activity. That's basically what's happened. No matter how they report it, that's what happened. Total folding of the lawn chair. And the purpose was what? So they can get a good vibe going for what? For the tax cuts and the debt ceiling and the dereg, where they believe that's where the juice is, that's where the fun is, that's where the markets will really enjoy it. Okay, so that's what happened. And so what does that mean? That means everyone who was trying to model this thing now can put in 10% as a model in their model, and that's obviously going to get you a better outcome than 145. Now, the other thing is order imbalances. I've been in this thing a long time. And when you see something happen today, I'm going to tell you what happened today. This news obviously was the same kind of news that you got on April 9th. Now, the last time it was this volatile was April 9th. Why do you think so? Because you're bombarding the people with something out of the blue. The guy went from what? We're going to get China. China, there's a bad people, and we're going to go get them. And the next thing, we're going to put a pause on this thing. Pause. That's like a shock. So that's why you got that first volatile move April 9th. Now, I don't know who's looking for 10%. Come on, the guy just said England's their most favorite guy. England and us go back a long way. UK and the USA all the way. And now China's getting the same rate as them. Throw out that fentanyl stuff because they're going to be throwing it out anyway. So, but 10%, that's what they're at. So that's a shock. And when you get a shock, you get a lot of people who are short and out of the market. Who's short? Obviously, anybody who's trying to follow the trends, because look, you still had some trends kind of spotty here, going into the weekend, right? A little bit spotty. And then basically, you have the people who are CTAs who haven't gotten long yet. And then you've got risk parity traders who haven't gotten long yet. So you're going to have an avalanche of buying. Now, whenever you get an avalanche of selling or buying, like 40, okay, look at the chart. Who do you think's buying at 4,800? The public? And who do you think sold today? The public? No. You know who's doing the buying down here? And you know who's doing the selling up here? They're called market makers. And they could include Citadel and other companies like that. Now, one thing about the market makers is they have to put their own checkbook in front of this freight train, right? So when the markets are collapsing, they got to put their own checkbook in front of this collapsing, shall we say, tank job. And they're not going to do that just any number. They're not going to take in all that volume with their own checkbook and hope it stops. They're going to work for a point where they think it will stop. Why would they think it's going to stop there? Because they've got moving averages too. And they can see the moving averages at 4,800 and the former highs are there. So they don't mind taking in an enormous amount of volume at that level because they can see there could be some very good technical support like there was here, like there was here, like there was down here. Okay. So that's why we go to these numbers and sometimes that's all you get. Now today, they had a number that they felt somewhat comfortable for. And I think it was right around the 5,800, 5,850 neighborhood on SPX. And they took in all the volume. And every Tom, Dick, and Harry who was short, who had to get out, every Tom, Dick, and Harry was out, had to put some exposure in there, coming in like, like a freight train. They were willing to stand in front of it up near this number. I mean, the darn thing opened up about 170 points. I mean, the thing was opening up pretty much where we closed, a little bit higher, I guess, on the close. They also got people who would not get out until the end of the day. Take a look at this. This is the day, double top, looks like it might be rolling over. And then all of a sudden, bam, new highs. Why? Because somebody obviously, and the traders were saying, get me out. I have these short positions. I'm getting murdered in. I don't want to carry them overnight. Get me out. Well, get me out with a lot of volume means the guys have to, again, find a spot that they feel comfortable with. And again, this neighborhood, they felt somewhat comfortable. So what is my point? My point is after a high volume imbalance, the order get balanced. And after you balance them out, you need to find new people who want to underwrite the higher price. So now you have to find people who want to buy at 58.55, and you need to find a lot of them to do it. Because why? Because you need volume to keep the thing going. So I would be on alert to see if it can have any trouble at this neighborhood. Now, this is for short-term traders pretty much, but I'm going to give you a little bit of a tip here. Okay. When we went up earlier today, where are we here now? Let me get on the 5-day. That'll give me maybe a better indication. Okay. When we went up here on the 5-day, we went to 77 on the RSI. Can you see RSI 77? Now we went to a new high and the RSI, well, Let's just see. Well, there's not much of a divergence up here. There was. At any rate, this is a neighborhood we have to be careful with. And again, this is a neighborhood where it's either going to go right through this thing like a knife through butter, or you're going to find out that maybe some of these gaps like down here might have to get filled. So this is a very interesting level for the S&P in my view. Why is it interesting? Because I got two moving averages coming in here, and they come in around 5,800 ballpark figure. And then I've got a 1 year thing that it came up here to purple, and purple comes in right now at 58.13. It's trading above both. So for all I know, it's going to go to 6,200 tomorrow, for all I know. But if it does start to buckle, and turnaround Tuesday is not off the table, and you got CPI coming out. I don't know about you guys. When I go out, prices seem to be higher than they were. So I don't know what the CPI is going to be, but I'd be in shock if it wasn't a pretty strong number. And Apple just announced they're hiking prices, and these tariffs are still 30% here and 50% there. So, I mean, I would assume prices are going to be raised to offset that. I don't think they're going to, companies aren't going to deliver and lose money on their product. I think they'll probably hike the price. So, at any rate, that might be something that would be problematic for the market. So, this neighborhood, it's a neighborhood around the 5,800, 5,850 neighborhood. This is something that, like I say, I would keep an eye on to see if it's going to break. I'm going to show you the futures market here because a lot of you guys like that E-mini. Let me show you the E-mini. It's the last stand. I mean, if it gets through this number, there is nothing resistance above. So, and you can see in the aftermarket here, it is backing off. So I don't think I'm talking out of school. You see that purple line? That's what I would defend if it looked like it was going to roll over. And that's 58.90 even. And the high today was 58.76. So it tried to go up there. Maybe in the morning it goes up there. But if it can't get through that number, this is a reversion line that has merit. And so I would watch that very closely. And then I would turn to, this is all for your short-term trader guys. I would turn to my 5-day and see if I could get something to tell me that it might be rolling over. Obviously, if it starts getting under the red line, that would be a sign. That's at 58.60 ballpark. And then you got the green line around 58.50 ballpark. And then you've got the blue coming in at 58.33. So there's a whole neighborhood here that if it starts to roll over, you could get a nice little drop because this thing really came up, and that's a huge gap, and gaps sometimes get filled. So you got to keep an eye on it here. And again, we had RSI at 88, right? Then you had RSI at 71. And then on a big new high, you had RSI at 67. I'm telling you right now, man, that's called Mike Tyson's legs are going out of him, meaning the market's going higher on less strength, but you don't have any evidence of a turn. And that's the key because this RSI stuff, that could be rectified on a big up move and RSI jumps up to 80 and you're back in the soup. So you've got an indicator that there could be a rollover up here, but it would be nice to have one of my red lines pointing down before you step in front of it so you have some place to defend against. But again, 58.90 would be a defensible number. And again, on the 1-day, it wouldn't take long for these things to roll over. So anything under 58.60, I think that would start a little bit of, and that's, see the highs here at 58.60. Underneath 58.60 might set a little crack in the ointment. So be careful. Like I say, this is a very treacherous market. Keep everything on a short leash and make your own decision. But I was just trying to point out a few things that I find interesting in the terms of order imbalance and in the terms of relative strength and divergence, which I think, like I said, I've been doing this for decades. So this is not my first rodeo of a big volatile day, up or down. And so I have a little way that I kind of figure out what the heck's going on. And it's not just panicking. That's not a good one. All right. So again, that's the story on the S&P. And of course, the big ones that are moving right now is the tech. So, the ones that really went nuts are the semis. So let's take a look at SMH. Because there has been a rotation and they seem to be dumping the safe ones and going into the riskier ones. And here's an example of it. Now, again, I've been telling people about this turn here for a while because you can see here, if you go to the long-term graphs, I mean, this thing went right to the blue line. I mean, that's where you buy. That's called reversion to the mean. So right there at 172, I know that's a good place to stick your head in. Now I go to my 5 year, and again, we're back above purple, very important. And once it did that about 190, that was another reason why it could pop back and have a reversion to the mean. Now this thing is right against it here, right? Where's my blue line? 237. Where's it trading? 237. So this thing is another one. And look at all those lows there at 240. So this is a neighborhood of problems as well. Again, right now they're playing happy days are here again, but maybe they step back and smell the coffee and they go, maybe it's not as happy as we thought. Why? Because the tariffs are still way higher than they used to be, which means prices probably have to go up. And nothing's etched in concrete. These are all, yeah, he said that, and Joe said that, and we're going to work on an agreement here. There's not, if you were selling real estate like this, there'd be no closings. Everyone has an offer of intent. Everyone has some things they like, don't like. That's not; those aren't hard deals. And so, since they're not in hard deal form, things could change, right? So we'll have to see. But the bottom line is no question this was a big, big throwback rally, and it's at a point where if it breaks through these numbers here, there's really a lot of upside ahead. So if this is the beginning of just great stuff out of the tariff news, and he's going to get the red ink budget, $2 trillion negative budget or whatever it's going to be, passed, and he's going to get the debt ceiling up 5 or 6 trillion bucks. There's going to be plenty of money out there again. It's going to be basically it's going to be the same thing that got us from 2008 to present, which is what deficit spending and running up the debt, deficit spending and running up the debt. It's not a new game. They might be coloring it different, but you still got red ink and you still got a debt ceiling that keeps going up. So what's the big difference? I don't know. Maybe, well, obviously a few different things that are going on. But again, if that's going to happen, then you have to be very careful about being anywhat negative in this market. Right now, the valuations have jumped back up to 22 PE. They're not cheap again, but the earnings were supposed to contract. And with 4% unemployment and everybody out there spending, I live in Nevada here, and the restaurants are absolutely full. My buddy lives in Phoenix, absolutely full. I don't know where you guys are living tonight, but people are out there spending money. And if they're done spending their own money, you've got Affirm and Upstart loaning you money, and you've got Alltimes and Klarna, and so people are borrowing money to buy their groceries. I mean, it's off the hook. So we'll have to see. Tomorrow, that CPI number is going to be very big, and that could be a turning tide, but we'll have to see. We'll have to see. Okay. So anyway, the semiconductors look very good, but I'm trying to show you that it's right into a resistance zone, so be careful. Now, NVIDIA has earnings coming out in a couple of weeks, right? Okay. Now, this company should be making a ton of money, right? But people were concerned about CapEx budgets being what? Cut. But most of the big guys told you they're not cutting it. That's great news for this company. And it had a correction down to the purple area. So that was the neighborhood to load the wagon. Now it's trying to turn up. I have a problem with one thing, though. You're not going to see people making big money in anything when these averages are pointing like that. So I don't know if this is just going to be some kind of a weird deal where it just gets through 130 and goes to 160 despite everything being pointing down. It's possible because look at the RSI right back at 50. So it's on the verge. This thing breaks above 125, 130, it's gone, especially if it comes in with good earnings. But if something changes, because believe me, I think one thing we can say in the last 3 months, things change around here, right? I mean, that's why I do strangles a lot. Calls and puts at the same time. Probably could make money on both the way this market goes. So the bottom line is that, we went from 145 down to 10%. We went from bad guys to most favored nation status. So, I mean, anything can happen here. And this budget, how much is going to be put, what kind of offsets are there? Are there any? We're going to find out. So if these guys come out with the good news and they break through this 125, 130, this thing could really take off again, because this company definitely has the chips that people want. Now, albeit they got competition coming in and they got cheaper ways to go. So it is not the same game as it was down at 30, 50, and 80. No doubt about that. But they still may have some juice in their tank. But again, we're going to find out pretty soon, because that is generally not what the charts look like when you go on a big extended run. So I'd say just be a little careful there. Some of the other big ones that people like to watch, Tesla. I've been pretty good with Tesla because I like to buy things like this when they're low. against the averages. So let me show you what I mean. In the last year, you see back here in August, you're down here testing purple. That's the place to take your shot. You're down here where gold and purple are together. That's the place to take your shot. Once red turns up and green and blue, I know I'm going on a big run. Once you go up to 550 and the averages are all down here, that is a reversion to the mean. It's at least going to go down to blue. And if it breaks blue, it's going to go down to purple. And if it breaks purple, it's going down to gold and even go under gold. Now, when it went down here, I go to a longer term chart. And by the way, you have triple bottom plus a turn up. So anything above 250 was a gimme. Now it's got some problem here. If it gets through this number here, and I'll tell you it's 331, it'll fly. If it can't, it's back in the soup. Now, here's the thing that helped me on this stuff. You see, when it was down there underneath gold on my 1 year, it was holding both gold and purple. They both come in around 235, 240. You notice that was about the low area down there. Sure, they bled it through a few times, but those things would tell me that once you got back above it, it's back on the bicycle. And again, you're back above blue, which is rising, which is nice as well. So this thing here, if it breaks 331, I think it could really go. If it can't, it's going to be back in the soup for Tesla, in my view. And again, this is sometimes where what strategies, would you want to use? Well, if something's coming down here and it's holding support, this would be the neighborhood that I'd price out selling puts. I mean, I was even showing people, you could get a 150 or 180 put and get well paid for it. And then you could take the premium and buy calls with it. So if it goes up like it did, you got a call that this guy paid for when you sold him the put. And the only difference to your break even is rather than having the strike price less the premium as your break even, your break even will be at the strike price. In other words, that's where you're agreeing to buy the stock. So that's one strategy. And the timing is key. Timing is key. And then, of course, another strategy would be your credit put spreads. Okay. What you don't want to be doing is getting involved in, I'll do credit put spreads. I'll do credit put spreads. Oh, the guy told me it never loses. And then you get into them up here and it goes down here. And not only do you lose your profits, you're getting wiped out of your principal. So you can't stick with one strategy forever because the markets do move. Now, as far as if you own a stock, some of these strategies you wouldn't do now because it's not the proper time. But here's what you could and should maybe have done. When you had the price up here and you thought it was going to drop. What you could do up here is what they call a collar. Say you own the stock and the darn thing you bought at 260. I mean, come on, you could have bought it at 260, 270, and within a month it was at 480. These things happen sometimes. And if you don't do anything about it, you give it all back maybe. So what could you do? You could sell an out of the money call, like the 500 call, take that premium and buy a put. Let's call it a 460, 480. And now you've got parameters around your equity. You can make up to $500. If it goes above, that's where you have opportunity risk. Or if it drops under 460 and you have that put, you have insurance at 460 until they expire. And who paid for your insurance? The guy you sold the call to. And then if you went out 3 months or something like that, when it drops down to here 3 months later, you've got to put up there the right to sell at 460. So all of this stuff is in your pocket. You cover your put, all this equity is in your pocket, and now you take all that equity and you load the wagon on the stock or you buy calls or call spreads. That's something that you can do, but you've got to know how the strategy works and you've got to know the risk reward of it all and feel comfortable with it. The other thing you can do when things are at high points is you can do replacement trades. How's that work? Well, you bought this thing at 260, 270, whatever you bought it at, it goes to the roof. Okay? Now you think it might keep going, so that's why you're in there. Obviously, at this point, you think it'll never come down, right? But you got to be cool. And you go, you know what? Probabilities tell me that we're going to have a reversion. So I'm going to sell out my stock here, take the 480 off the table, and then I'm going to buy a call spread at 500 and 550. And if it goes up to 550, I can make $5 minus whatever I paid for the spread. And the rest of the money goes in my pocket. So if the market collapses back down, yes, I lose on my call spread, but that was my hedge just in case it kept going. And the rest of the money is in my pocket. And there's nothing like having money in your pocket when the prices drop like this. Ask Warren Buffett. The guy's been loading up on cash like you don't know what, obviously waiting for some good opportunities, right? So there's a couple of things on a timeliness basis that can be very, very effective, both on the up and the downside when you're trying to either take advantage or you're trying to hedge a position and protect your equity. Because again, as you can see, things go up, things go down. I mean, there's one of the best companies you could ever buy as far as how it has done is Meta. But let's take a look at Meta just so you get an idea on this. Meta Platforms. Now, I mean, this thing was down at, well, let's go back a little bit further. Just give you the last 24 months. Yeah, check this out. Back in 23, 24 months, less than 24 months ago, right? Well, about 20, yeah, a little bit more than 24 months. The thing was trading at $50, and it had been trading at 400. Talk about something that can move around. And then it goes on this kind of a run up here. Again, reversion to the mean. Didn't go all the way down to purple, but it gave you a pretty good opportunity, with a double low there, and then get back in at 520. And now it's off to the races again from this standpoint. But again, this is why you need sometimes to protect your equity, because 750 to 500, that's $250 out the window. If you had 100 shares, that's what, 25 grand or 250 grand or something like that. It's a lot of money. A lot of money. All right. So that gives you some ideas on how different ways to use the options and different ways to take advantage of the options. Now, I did want to go over some of the markets, and then I'm going to go over some of the strategies I talk about in the option service every week. Let's go over some of these markets so you can see what's going on. I already went over the stock market, and I'll go over one market that I've been telling people about, which is called the Russell Index. Now, people are getting very excited. They think the Russell's ready to go again, and it might be, but I'll tell you right now, the jury is definitely not out yet on this baby. So here, if you look at the 20-year graph, the only thing it did was it hit a peak. It double peaked from the 2021 high to the one we just had. So it never really made new highs like the S&P did and then the QQQs. So that's one thing that was a problem, right? And that obviously was telling us that this rally may not last at 6,000 on the S&P. So that was actually a pretty good sign because the Russell did not participate into new highs. Now, it rolled over at 230 and it's been coming down. This number here to me is essential that it gets and stays back above. So once it got above 195 here, I thought that it would have a rally, which is what it's doing. Short interest in the Russell is 35, 38%, which is enormous, which means people are shorting the Russell as a hedge. Now, if they take their hedges off, as they probably have done lately, it obviously makes it go back up. But there's still resistance right there. And that's 217 to around 217 or so. If you go to the 1 year, there you got both of them waiting for you at 215. So can it go through there? Yeah, look at the RSI. Looks like it's rising. Maybe it will do that. If we're going back to 6,000 on the S&P, if in fact we're having no recession, if in fact there's no unemployment spike coming, if in fact consumer spending and all the tariffs are going to be low like China's is, maybe it keeps going. Maybe it keeps going. But this is a neighborhood that I'd be careful at because, again, you have a low here that came in at around 214. Then you've got these numbers coming in at 215. So there is a lot of reason to believe that this neighborhood could be trouble. And today we went as high as 210. So you're only 4 points away from trouble. And if you notice, it's not getting closer to trouble. It's starting to move away from it. So be careful of the Russell. There'll be a day, I guess, when it becomes great. But the first thing it has to do is get above 215. Once it does that, and if you can get these moving averages here that are way under here and make them look kind of like they did back here, they'd be more interesting to me. Because this is called a bull market and this is not. And if you get sucked into bear market rallies, you're not going to be very happy when the bear comes back out of the woods. So be a little careful. All right. So that's your Russell index. We went over the S&P. Let's go over the VIX because this is a key. See, my feeling was that we would go up towards 5,900, 5,800, whatever on the S&P, and that the VIX would go to 18 or 20, and that would be it. If it was just a rebound rally. Okay, so where are we here? Let's go to the 20-year. We can't see it very well. because I have the wrong thing on the screen. Let's try to put the right thing on the screen and you'll see a better deal. Okay, so let's take a look and see what's going on. Okay, can you see where's the moving averages come in here? 18, 18, 65, 18, 18, 18, 18. It's a lot of 18s on the board, right? What's the VIX at right now? 18. Is it possible this is the low on the VIX? It's possible. Is it possible 5,900 or so is the top on the S&P? It's possible. How are we going to know? Tomorrow, Wednesday, Thursday, Friday, as the news comes out. But at least you're aware that this is a neighborhood that it could stop at, whereas most people may not know that information. So that's where I'm getting 18. If I go to the 5-year graph, you can see the purple comes in at about 17. So 17, 18, 19, you see everything up here, 19, 19. This is the neighborhood. I'm not looking, it's not an exact science. Just tell me the county. You don't have to tell me the street, right? We're in the county of where the VIX may stop going down. If it doesn't, we are going to probably go up and make new highs on the S&P, okay? Because under 20, people are very comfortable with the volatility of the stock market, and to get them to come out of the cash sideline and put money in will be a lot easier. So VIX 20 to 15, people will buy into the stock market. VIX gets above 20, people take a boycott. Nobody wants in, too volatile. That's crazy. I don't want in. And therefore, you get drops to 4,800. So keep an eye on the VIX. I think it's very important. Another thing is the 10-year note. I mean, this guy dropped, he has dropped Fed funds by 100 points since last September, yet the 10-year is up. Figure it out, right? He cuts and the rates go up. Why is that? I'll tell you why. Because we have a $2 trillion budget deficit, because these tariffs could slow down the economy and slow down margins and slow down profits. And we have a national debt that they're going to be raising 5 or 6 trillion more dollars, right? And we're trying to get people to borrow money from us. And that is making them want more interest. Not to mention, if there is any inflationary fact that comes with this tariff stuff, that's got to be factored in, because, you know, they're trying to get to 2% on inflation. Okay, so when they come out with a number tomorrow, if it's 0.3, right? Well, 0.3 times 12 is 3.6% inflation. So that's not 2, is it? Okay, so that's one of the problems. And the other reason this guy's on pause is he has no idea how things are going to get shaken out. They were 145 tariffs, now they're at 10, but what are they going to be in 6 months? This guy's managing the entire financial system. If he would have dropped rates and then this inflation takes off and the market goes up to 6,500, he might have had to just hike rates again, and he'd look like a moron. So that's why he's sitting on his hands, because there's wild cards all over the place. Human wild cards, event wild cards, plenty. So keep an eye on this, because you see it is trying to break out a little bit to the upside. And I have been a believer that rates are in an up cycle. In other words, the trend for interest rates are to go higher. As you can see, this is when they cut in September of last year. Everyone thought the 360 was on its way to 3%, 250. Not me. I said it's going against my blue line. This is a great place to short the bond market and buy into some yields that what do you call it? Or you know, look for a rising yield. Look for a rising yield, and that's exactly what happened. Recently, we just went under again. Okay, so here's my thesis. If we start closing under 4% and 390, you will get your cuts. But that's not what the RSI is telling me. That's not what the blue line's telling me. It's what a bunch of bond salesmen on Bloomberg and CNBC are telling me, because they would love to see rates drop, because this is their investment since 2020. Do you think their investment has been rising in value or dropping in value if you're a bond salesman? Everything you've sold has lost value. So, of course, they like to see rates drop, because they'd like to see their clients stop calling with their whining, right? Right. So keep an eye on that. Another thing I was quite good on is the dollar. I love when things get to extremes. Here's the extreme here, 98. So this is where I thought, now this is a very ominous looking thing though. because if it can't get above 105 and if it takes out 98, it's going down here and the dollar is going to get quite weak. But right now, I thought this was a good place to buy into the dollar around the 98 number. And basically, the converse of the dollar would be sell the euro. So here you go, just to give you an idea how that looks. And here's the high on the euro at 116. You see, that was when the thing hit 98. So I thought this was a good sale. And so far, that's been the case. Now, again, this thing could still go down to 109. It could lose all of its gain for all I know. But if that dollar index takes out 98, then this baby is going back up, and Lord knows it could go up to 120 for all you know. Okay, so keep an eye on 98, keep an eye on the euro. And that's the two things on the dollar. What I cover also each week is the international markets, which I'm going to show you real quick too. And again, I was a big believer in the international markets going back up because exactly what happened. I thought that Trump and the tariff stuff was going to be all bark, no bite. And I think it's turning out a little bit like that because the pain that would be required is intolerable for the administration. In other words, the pain of big, slow economy, unemployment jumps, inflation all over the place. People's stocks are all going down. That is not, they have no tolerance for that, right? So when I saw Europe way down here because they were afraid of the tariffs down here, I thought it obviously was what? I thought it was a situation where it was going to be going back up, which it did. Then, of course, he went out with all those ideas that he was going to hike those hike those things to 150% or whatever. I thought that was a joke as well. So this was another area where I thought it was a ridiculously good place to go in. And this is Europe. And the number one place in Europe, as you see when it came down in April, it came right down to the gold line. See, with these lines, I have an idea why I'm getting in and what I'm defending. What are you defending? Here I was defending the yellow line. Okay, now let's look at the two biggest things in Europe. One is this guy here, which is Germany, because they're the guys who actually have the budget room to stimulate and spend money. And that's why this thing has been one of the better ones. So EWG has been my favorite thing for Europe. And also in Europe, the banks. They have also been a place that have been very, very good to park. And as you can see, that's what a good deal looks like, right? Steady, 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 and still going. Now it's overbought up here, and there's a divergence. So I'm not saying now is a good time. This is when I thought it was a good time against the blue lines. All right, what about Mexico? You know, they've kept their mouths shut, and it's helped them. So you're going to see right now how it helped them. It's held down here and it's on the upswing. It's having some trouble here, but again, they haven't caused a lot of waves lately. And look what has happened lately. 48 up to 60. Nothing wrong with 20%, 25% jump. Nothing wrong with that. Not now, but when it was down, that's what I was talking about. And so that, you know, and then China, of course. This has been my best idea all year. So I'll show you my best idea all year. Alibaba. I love Alibaba. Okay, let me show you. The first thing that happened last year is they came out with a stimulus plan, right? And I really enjoyed China, and I did catch this action right here. What happened was their stimulus was ineffective. So they brought it all the way back down on a reversion to the mean, right down to my numbers. And you had a convergence of my moving averages, which generally is always a good time to take a good look. Then we turn up and all the averages are turning up and you jumped above purple. This was one of the most easy things to identify. We looked at a $90 call for 500 bucks getting off the board April 5th, April 17th. And of course, by what? By February 21st, it was already at 145. And by March 17th, it was at 148. So obviously, the $90 calls, if you held them for any length of time, would have been a pretty good deal. So, but now, again, we had the big pullback. You get down by the full reversion. This is where you take your shot, okay? Because it's had a full reversion and you have a place to defend. What do you do up here? You congratulate people who did this, or when it got above purple, did that. But I don't see this as an entry level. Probably will go up and fill that gap, but it also could go right back in the soup because that blue line is pointing straight down, and that's not a good thing. So that gives you some of the international flavor that I keep you updated on. And this is another one that I've been very big on. And this is Bitcoin. I don't know anything about Bitcoin. I do know one thing. Tom Lee seems to be a pretty smart guy sometimes, and he does believe that after halving, that Bitcoin will triple in value sometimes. Okay? Well, what was Bitcoin when they did the halving back in 2024? 50 grand. What's 50 grand times 3? 150 grand. So I've been thinking that it's going to go maybe to 150 grand. And I'd be willing to do limited risk option spreads on something that would benefit from that. So let's take a look at MicroStrategy. Can you see? Well, I'm going to show you the 5-year graph because it's even clearer. But the 1-year graph is perfect too here, because as you can see in March, we had 2 tests, test there and test there. So obviously that was your neighborhood where you could take your shot. And I've been looking at long-term options there, going out to December and sitting on them and using it as a proxy for being involved in Bitcoin. So if it goes up, to 4, if you get in down here and you do a call spread, you might be able to put up 2 grand to make 10, or excuse me, 2 grand to turn it into 10, or more if you went with further out of the money. More risk, more reward. But like I say, now you've had a big run. This is what got me interested in it as far as the 5-year. Can you see here? This was when we were trading around 150. Again, the averages are converging. This and the blue line's rising. And Tom Lee's talking 150 grand. This was the best thing we did in it. And then we had this kind of run. You get a run like this, you're looking for a reversion to the mean. Where's the mean? Right around here. So this was the next neighborhood, 250, 275, to take another shot. And once we got above 300, you can see, bam. So is it on its way to 5, 6, 700? I don't know. Is it going to have a pullback first? That's possible. But the trend is up. And the guys who think that the tripling after halving is on the is still on, and they tell me that sometimes it was supposed to be expected by June or July, which is only a couple months away. So this could be a very exciting market. And again, limited risk options where you know to the penny what you're risking, still have a reasonable profit potential. I think might be better than buying Bitcoins at 120 grand and finding out, or 100 grand and finding out that it didn't happen. Let me show you Bitcoin so you can get an idea. And of course, there's other stocks I follow that seem to benefit from it, like Hut, like what do you call it, Robinhood. They seem to have a little bit of a affinity with those things. Anyway, so let's look at Bitcoin, and I can just show you here. And again, I was using the 5-year graph to smooth out the spots here. You know what I mean? Because, some of these charts are all over the place, but these things get smoothed out. So can you see when it was around 65, same time that, what do you call it? MicroStrategy is 150. I thought this thing was consolidating and going to explode out of here because the blue line's rising. Okay. Then it pulled back. Why did I think it would pull back? Because this is a gap and gaps get filled. This is the former highs, and former highs become support. So we went down to 75 like clockwork. And once we got above 83, this thing was back on. And back above 90, it's back on, and back above 95. So is this going to fail from up here? It's possible, but that trend still seems like it looks pretty good. So I would consider pullbacks to still be buying opportunities, providing we can stay above the 85 grand neighborhood and even 90. We'd want it to stay above there. So that gives you a little bit of a tip on the Bitcoin type thing. And again, every week I bring you up to speed on what I'm seeing in all these markets. And again, I follow them all. It's very easy when you've done it for a long time. Some people are looking at the banks, and I'll give you, a couple of different ones that we follow. I like JP Morgan. It's in a very nice uptrend, and it's breaking out, and it's one of the stronger ones. Its 50 and 200-day moving averages are inverted to the upside. This stock and IBM, in my view, are two of the strongest stocks out there because their moving averages are still indicating an uptrend. Now, albeit they're 245 on the 50-day, 248 on the 50-day, and 225 on the 200-day. So that means you could get pullbacks, but it does still seem to be a pretty good deal. If it's going to continue, believe me, I think JP Morgan will be there. And again, the other one I showed you or talked about was IBM. And IBM, their moving averages are under the market and rising as well. And that's why every time it dips, there seems to be good buyers, right? So again, this thing is trying to get back on the bicycle. But that thing has been just fantastic. Look at the 1 year. I mean, it comes down to purple, you buy, comes down here, you buy, comes down here, goes back up, test the purple, consolidation, it's going to pop on earnings. It does, comes back and has the big test during the big everybody's selling everything deal. You got something to defend. Now you're back on the bicycle as long as we're above purple. So as long as you stay above 235, 240, 242, this thing still looks like the surprise could be to the upside. The only way it wouldn't be is if the entire surprise that we're acting on today is a bologna sandwich and the news changes back. And that would obviously, maybe send everything back down again. That's not the way the cards look right this second. But again, in this world, in this environment, you've got to be flexible on both sides. Okay. Because again, the news and events could change pretty significantly. So we'll have to see. But that gives you a couple of stocks that I'm following that have been pretty good. Google is another one that we've had very good luck with, and I'll explain why there. It's a trender. You get a thing that's trending, it's pretty good to work with. So as you can see, this thing was going up. This is an uptrend, right? And it's been in a downtrend since 195. And look at it follow the red line all the way down. Yeah, it had one little rally here. That's just something you want to sell. Because when these things go up and everything is pointing down, it's not going to last. It's not going to last. And again, that's why this thing is in a kind of a mess right here, because it could, there's a gap. Believe me, I don't not see that. So at some point, it's going to probably go fill that gap. I don't know if it's going to be later in the year or what, but at some point, it's got a good chance of going up there. Clearly, if you break above 165, 168, and above 175, I definitely would be looking for that thing to get filled. But right now, these two guys here are going to be what they call a formidable opponent, maybe. So that's what I'd be looking at. And on the 5 year, see, this is where you're trying to take your shot. So if the lows are in at 150, that red line is still pointing straight down. But if they are in and you get above this neighborhood here, going up to fill that gap, the odds will be getting better and better, particularly if the whole board changes. But notice RSI is under 50. So are we out of the woods yet? I don't think so. In fact, I wouldn't even make a statement that we're out of the worst of it yet, because we don't know how earnings are going to be. We don't know exactly how inflation is going to be, and we don't know what valuation they're going to be willing to spend on earnings. Let me give you an example of that, because a lot of you guys are, and me too, we're always looking at charts. We're wondering what this guy said. Oh, that guy's on CNBC. What about Kramer? You know what it comes down to? It comes down to two things. One is earnings, and the second is valuation. So when we were at 270 on earnings and they were paying 23 times 270, it made sense that the S&P went to 6,200. The top was 6,150, right? So what would happen if earnings went up to 300 and they were paying 23 times earnings? You'd be at 6,900 on the S&P. What if earnings went from 270 and contracted down to 240? And then they only gave you 20 times on earnings. Then you'd be at 4,800. So you can see the volatility on the S&P is going to be determined, in my view, by how the earnings settle out and how much they're willing to pay for a dollar of earnings. This paying over 22 times is a excessively high historical number. And if there were to ever be a slowdown, the number could go into the 17, 19 area very easily. So that's why that's going to be the determinant ultimately of where we go. And when Tom Lee and people like this use numbers like 7,500 on the S&P, they may say that, hey, listen, earnings are going to go up to 300 and they're going to pay 25 times because everyone's going to be panicking in. That would be 7,500 on the S&P. So, if earnings keep going and going and going, and if their willingness to pay high valuations keeps going and going and going, the numbers can get pretty hairy on the upside here. So, like I say, keep an eye on earnings and keep an eye on the valuations. Part of the valuations is interest rates. So if for whatever reason we got above 5% interest, I think that would be a very key area where a lot of things might have to be recalibrated. So keep an eye on that. A couple of things like on the price of gold. Again, it's not I call the market on this stuff. I read what I read and I see what I see, right? So let me show you what I see on the gold. The gold, again, great place to buy in November of 24. Great place to buy in December of 24. Decent place to buy in February. Decent place to buy in April. Not a bad place to buy here. So you try to buy against the lines. Right now it's being tested as we speak at 3,200. When it was up at 3,500, I thought it would come back towards 3,200 for two reasons. The blue line was around 3,200, and this is the former high. Do you remember what I showed you at 4,800 on the S&P, and the pullback would be to that former high? Same idea here. Now, if we get back above 3,300, then it's back on the bicycle maybe, right? And since the RSI is coming off 50, that might be what happens. Maybe the news changes. We're up 13 bucks in the aftermarket tonight. Maybe the news changes and they sell the stock market down a bit and the gold gets back on the bicycle. That's the story on gold right now. If we were to break 3,200, you can see going down to 29.50 or even 27.50 on a full reversion is not off the table. There's your 3150. So going back to the red line here would be the 3100, 3150. To go back towards this one here would be your 2850. So the 5-year and the 1-year gives you some coincidental levels that it could pull back to. Let's look at oil. Again, drill baby drill. They're not drilling at all. Do you know they're walking away from the rigs in Texas because the price is so low? They're walking away from the rigs. So this is the story on oil. It's in a downtrend. OPEC is having a war, a price war, and Saudi can win that war in a day. So if that's what's going to happen, we could go into the 40s, right? But I've got a double low here with RSI at 40 and RSI at 40. RSI when it hits 40 is either one of two things. It's on the precipice of collapsing and accelerating to the downside, or you're looking at the bottom. So I would say these two lows are very exciting because if they get taken out, and that looks like 55 bucks, in the abyss we will go. If it does not take it out, then that could be the lows, and we could try to make some work higher. It's against popularity. It's against the trends here. So again, it's a rough bet, but it is holding on to double lows here, but there's a lot of resistance above. So maybe best case is it's stable. But again, you can see here, it's hanging on for dear life. You take out 55, you'll have a 40 handle. You might even get lower for all we know. All right. What I'd like to do now before we close up is just explain how I can help you. Okay. Now, I have a thing called the options alert service. How does it work? Every Sunday, I give out an alert. And in that alert, I review the markets and give you my views. And I also give you current events and my views. And then I give you ideas. The ideas involve strangles sometimes, where we buy calls and puts at the same time. What I'm trying to do with those things is I'm looking for premiums that are in the $150 to $300 neighborhood, where obviously the premiums are relatively low for both sides, that I think news and events will move the markets and increase their volatility. which means the seller of those options is not taking in a very large amount of premium, and he's going to get whacked in the back of the head if volatility shows up. Now, obviously, in the last few months, volatility has really showed up, and some of these strangles have gone up dramatically from the $200-300 values of what they. Don't forget, when you buy a long call and a long put, your risk is limited to whatever you pay. So if you only pay $200 or $300, that's all the risk you have, and your return will be determined about the volatility. So I have found this is not a bad thing to look into. And every week I show you some. And again, it is limited risk with potential volatility dictating how much money you can make. So, and you don't have to do both sides at the same time. So if the market's clearly going up, you could do the call first and leg into the put when you see you need it. Same thing on the other way. The other thing I show you each and every week is I show you some long spreads. And to give you some ideas, a couple of weeks ago, a lot of people don't want to buy the stocks because, again, they were very shaky up until today, right? So why not use replacement trades? So I showed people some Broadcom going out till January of next year. Buy the 205 call, sell the 235 call for $2,500. If we can go up to, well, let me show you real quick what some of these look like. I'm sure you guys all know Broadcom, right? So again, Broadcom had a nice big drop down to the line, 140. It's back on the bicycle, right? And we're looking to see if it can go up towards 235 by January of next year. And if it can do that, $1,200 could have a full value on the spread of $3,000 because the difference between the two strikes is $30. That's a replacement trade. It gets you into Broadcom with a limited risk situation for $1,200 rather than buying 100 shares for $22,000, right? Now, the other one that I had been mentioning also was, this is a couple of weeks ago, Taiwan Semi. And the strike price on Taiwan Semi was 180 and 210. So we're looking for Taiwan Semi to go back to 210 by Christmas or December 19. So it has to go up to 210 by December 19. Long 180, short to 210. $1,200. $1,200 to $3,000 if we can get the full spread, which means the time is run out of the top options. There's no time value, just intrinsic, and it's above 210 on December 19. Sometimes I look at things that are out of favor. 2 weeks ago, I looked at Disney. They had earnings coming out. The stock was out of favor. So we looked at a strangle. 95 calls against the 60 puts for $329. The stock was way down here, but it was turning up. So you take a shot at the 95 calls before their earnings, and this thing is up at 110. 110 minus 95 is $1,500. Your total risk was $300, $329. They don't all work that way. That's why you got to trade them. But clearly, there's some merit to this, I think. And clearly, for risk capital, part of the risk capital used in this area is not a terrible idea. Another one that sometimes they get out of favor. I just did last week, I was talking to people about getting involved in pharma. People say, what are you out of your mind? I said, listen, there's only two things going to happen to pharma. It's either going to snap back like it did today, or it's going to really, really go down if he gets going with what? All of these cutting of the things. But, the transportation index has been very much hit. So I looked at a company last week called JB Hunt. And that's not JB Hunt. So let's get JB Hunt up there and you can see JB Hunt. And you can see JB Hunt is a trucking company, anybody who knows anything about it. And the stock went all the way down here from all the way up here. So the 150 calls, were pretty cheap, and the 115 put. And now it looks like it might be able to go on up. And if it does, it's up another $4 in the aftermarket. So I'm certainly happy that the 150 calls are now in the money. But again, these are some of the things we're looking for each and every week. So basically, how do you get involved in this is pretty simple. There's two ways. You can either do quarterly, and that means for every 90 days, you'll have it for 90 days. You'll get alerts. You get coaching. Me and you can actually talk and go over options, option trading, different ideas, my ideas, your ideas, and I can help coach you to get you to be a smarter option guy. Also, you get webinars every Tuesday and you get an options class. So you get a class, you get ideas, an alert, you get coaching, and you get a webinar, and you get it all for $297. Believe me, that's a ridiculously low price. Or you could do what I think is a better deal and go annual. Then you go for $895. You get 4 times the alerts, 4 times the coaching, 4 times everything for $895. So David's going to be putting up a link, and let me just see if you guys had any questions. Yeah, I went over the NQ and QQQ. I can do that in a minute. But anyway, let me see. Okay. Yeah. So anyway, yeah, that's what you get. That's what you get. You get 4 basic things there. And again, I mean, at 297 and 897, those are very, very low prices. I don't know how much money you guys have at risk in the market, but I mean, if you have any decent sized money risk, you should walk away with a lot more than you're paying for as far as education, knowledge, coaching, everything else. If we can give you some good ideas, God bless us. But, even without good ideas, you're still going to come out on the other side, I think, smarter than when you walked in. Also, if you get ideas from other people and you want to run them by me, that's not illegal either. I can give you my opinion and my view on things that you're hearing about elsewhere. I had a guy today. I'm hearing about iron condors and calendar spreads. And what about vertical? Okay, a lot of that stuff sounds very complicated. I know how to cut to the chase and tell you what the risk reward is on it. And you can determine whether the risk reward is worth playing or not. Because some of these spreads I see, you couldn't buy an extra piece of cheese on your cheeseburger if you win. And if you lose, you're going to lose your car. So that's not the kind of deal I think looks very good. So again, if you're looking at strategies elsewhere, I can give you a little bit of help on that as well. So yeah. And by the way, I work with trading indicators, a guy named Daniel Sinig, who is very sharp in technical analysis. And his company has a large number of indicators that can be used to help you with your short-term trading and other types of trading to enhance, hopefully, your results. So every Tuesday, Daniel and I do the webinar together. And all of the alerts come from info@tradingindicators.com. So when you get signed up here today, remember, you're going to get your class sent over to you immediately. You get that, options masterclass sent over, and that's a $397 value you get for free. You're getting coaching for free, which is supposed to go for $200 an hour, but I put it in there for free so you can get as much out of the alerts as possible. And again, they all come from info@tradingindicators.com. So check all your folders. And if you have any trouble, now, like I say, if you do end up signing up, I'm going to give you my cell phone number. And what you do is you text me and you go, "Hey, Jim, this is Bill. I am a subscriber and I'd like to have a meeting with you if I could at 4 p.m. on Tuesday." I check it out. I text you back. "Okay, Bill, call you on Tuesday, 4 p.m. I'm on Pacific time. A lot of people are not. So sometimes we can do things after work that make it easier for people to, be calm and in front of their computer rather than trying to learn while they're running around running their business. I always think that's a better time to do things, sometimes after dinner. So yeah, I try to make sure that everybody gets more than what they pay for, that they are way more smarter when they leave than when they come in. Again, I do wish sometimes people would take more advantage of being able to ask me a question rather than stay in the dark. So again, I'm trying to encourage everyone, like I say, if something comes up, like say, well, whatever comes out, you should just text me, have a conversation, and let's see if I can, give you clarity where you might need some. And I think that's a big feature here because I have done quite a bit of business in this area and I have been, teaching options for decades. So I think that's helpful. If there's any other questions, you can shoot them in the chat box. And I did want to hit something on the QQQ real quick and NQH. So NQM, hold on. because you need to know levels. And the $500 level on the QQQ is hugely important. I'll show you why. Yeah, you're at 507. So you've gone through it. See, you've gone through it. See 500, you've gone through it. Now, again, if this thing just goes right back under 500, this was a baloney sandwich. So this is why this is a key time frame, because today nobody wanted to sell except the market makers, and they raised the offer as high as legally available, right? So we'll have to see if there's new buyers at 507 who want to take the baton. If there's not, and the news changes, then these gaps could get filled. So again, be careful of the 500 number on QQQ. Okay. And then on the NQM, let's see what that has to say. Okay, you see right up against it. So again, this is the neighborhood, and this is what, 20,852. So 20,852. If we started trading underneath that, it could increase the odds that we could go in and fill some of this in here a little bit. And you do have a high point here with 76, and you got a high point here of 71 and 68. So you're getting a tiny divergence. A move under 28 obviously might be telling you there's a crack in the armor. But this thing is strong, so everything you do, you have to be keeping a very close eye on it because of the fact that, you can't step in front of freight trains. You don't fight the tape. The tape is up. But if you want to take a shot because you're at a key point, I'll give you one that I showed to people before. Nike. Now, who would have thought Nike's any good? The thing's like constantly going down. Well, I thought it was good at $54, $52, and I'll show you why. Who would know? Who would know to look at this unless they were using the stuff that I'm looking at? Who would know that 52 is the neighborhood to take your shot? So that's why I use the things that I do. I'm confident in them. I like them. They're based on time and price, not on waves this and wave that and Fibonacci this. Da, da, da. Just give me the numbers and let's see what the flow of the action is. That's what I like to do. And I love using the averages for reversion to the mean because, again, reversion to the mean is an excellent time to do business, either at the purple or the gold, generally speaking. It's certainly a place to take a look, as you can see here. Reversion to the mean. How would you possibly know that it might stop there if you didn't have some type of a device showing you that, right? And like I say, I try to work with you during the coaching sessions to try to enhance your returns and enhance your knowledge. So, David, did you get a chance to put up the link? I guess you do have the link up there. Yeah. So if you click on that link, you can get started. If you want to speak to me directly, you can just shoot me an email. And the email is optionprofessor@gmail.com. And you could say, Jim, I was thinking about joining, or I am joined, or whatever. And then, of course, once you join, I give you my cell phone, and you text me, and I text you back so we can keep in contact when need be. Again, I'm Jim, the option professor. And I think I covered everything now. Yeah. So I got everything done now. Thank you very much for being here, guys. And like I say, let's try to get in touch. If you're trading the markets and you want to talk, again, shoot me an email, optionprofessor@gmail.com. And if you want to try it out for 3 months, and after 1 month, you go, you know what, this is helpful. I'm going to go for the year. We can give you a credit for part of your subscription to be applied to the annual and still give you the discounted rate for the annual. So, give this thing a go. I think you'll be happy with it. And like I say, I'll do my best, obviously, to help you with that. GLDF to 308. Let me just see that real quick. Last thing. Gold Finder Resources. Well, that's 50 cents. Huh. I don't know what that's all about. I will show you a couple of cheapies right before I leave. These are options that I paid like $100 for, and they look like they could go. Maybe. Let's find out. This is called Soundhound. And it looks like, down here, I thought it was going to turn up, and it looks like it's trying to do something. And if it does, it could go. One we did very good with on the cheapies was D-Wave right before their earnings last week. And you can see that was a good deal because, again, it consolidated. I thought it would break out to the upside, and it did. I thought Rigetti could possibly do something here. It's trying to, and but it had bad earnings, so it came back in. But it was a good pop. From here to here is not a bad pop. And then the SoFi, last one. And again, SoFi, had a nice run because we thought it was going to hold this thing and have a pop, and it's had a nice little pop. If it gets through here, it's got a good shot of going somewhere. So those are some cheapies that I was focused on. But again, if you have any questions on anything, again, shoot me an email, optionprofessor@gmail.com. If you get signed up for us, I'll make sure I send over to you I'll call you, and I'll also send you my cell so we can text each other when need be. All right, guys, thanks a lot for being here. This is a special report, a lot of things going on. So I was very happy to do this thing as a solo instrument tonight. I'm hoping you guys did get a lot out of it. I appreciate you being here. So again, good luck and good trading. And if you sign up here tonight, welcome aboard. And if you do sign up tonight, I'll give you the last 2 weeks of alerts for free so that you can catch up to speed on some of the things that I've been talking about in the last 2 weeks. Okay, thanks a lot, you guys. I'm going to send it back to David now. And again, have a great day.